The cost and value reconciliation is a tool widely used throughout the industry and particularly in the profession of quantity surveying. Quantity surveying or quantity surveyors generally tend to use the cost and value reconciliation as a means of measuring or quantifying the levels of profit or loss that are faced by the project at a moment in time. Or otherwise, it's almost as if it's a financial snapshot of the project, and if the project is experiencing a profitable period, or if the project is experiencing perhaps a loss-making period. And to this end, the cost and value reconciliation, also known as the monthly cost report, is a crucial instrument and tool that every good, upcoming and seasoned quantity surveyor should possess. Now, just to give a run through, we have a template cost and value reconciliation. So I'm going to run through this almost step by step so you can get a feel of perhaps what a cost and value reconciliation is, what a good one should look like, and how you would also go about filling this out, populating all of the critical figures in here to ensure that you are reporting as accurately as you can at the moment in time that you are carrying out the report, the financial prowess of the project. So, firstly, we shall start with just the particulars of the project. So we have a contract name. In this, I've aptly called it the QS Guide, prepared by myself, Anthony Hill. And we go through these parts. I mean, the main ethos here, or the main thing to understand, is that, you know, what you are trying to present is something that is auditable and transparent, and something with enough information but not too much of an information overload, so as you're able to make reference to your reports in the future. Right, I'll scroll down. So the two main parts of the cost and value reconciliation are, in fact, as the name suggests, the cost and the value. Now, an idiot's guide would suggest that, and I must say, and I must stress the importance that value, aka sales, minus costs, immediate costs, as in costs that have been borne and conceded, as well as accruals, need to be taken into account. Now, the net figure will either give you a positive or a negative, and the positive being profit, potentially, and the negative being loss, again potentially, because, you know, we could go into detail about what actually comprises a profit and what comprises a loss, and at what stage it will be classified as profit or loss. So to resume with the CVR, we have the gross application value. Now, this is the application value to date. Most applications that are made by quantity surveyors on projects tend to be cumulative, or what we call gross. Now, these gross applications are generally submitted, depending on the contract, on a monthly basis to the client, who in turn will value the application, provide a payment certificate, and pay accordingly. Now, in this case, the previous month CVR was had a value of £443,000. The current value or valuation or sales was £552,000. The movement being £107,000. So that £107,000 should ring out as being the movement within the month, also known as the application for the current month or current period. Now, if I go down to the next tab, or the next cell, we have the gross certified value. Now, the gross certified value shows what has actually been certified by the client, by the authorized body that is making an assessment of the application. Now, in this case, to keep it realistic, what I've done is I've sort of said that the £443,000, as highlighted here, that was applied for in the previous month has been certified. However, at the moment in time that we carried out the cost and value reconciliation, there was still not any formal certification. So what's actually been certified was actually that of last month's valuation and application process. And what I've done is I've included in other invoices what we believe should be certified but is not yet certified. So this in effect is monies to come, value to come. Now this, once this hits the cost report, which is a prerequisite to carrying out any of the valuation, any of the cost and value reconciliations, any of the monthly cost reports, needs to be shown as not certified, because it is technically incorrect to say that the sales have been certified if it has not one, had formal certification from a client, and two, the cost report doesn't suggest that we've had the sales into the bank account. Overvalue. Now, the overvalue is an easy concept to grasp. This is simply where perhaps you've applied for something or you've secured value or sales. I'm going to use the terms value and sales interchangeably. And what this essentially means, and you'd use this and you quantify overvalue specifically for instances whereby you may have actually claimed or applied for monies that perhaps are not necessarily due, but you've actually overvalued, or in construction terms almost over-egged your application. For instance, you may have claimed 70% on the substructure of a community centre, when in fact 50% was perhaps more representative of the works carried out to date. The overvalue really is an internal mechanism to really show those that the report is aimed at, and those who analyse the report. It sort of says, if we have actually had more money in than perhaps we should have, there will be an artificially high reading in the profit function. So this is really just to get a grasp of what the terms mean, how they're applied, and what influence they have on the monthly cost report or cost and value reconciliation figures. So, and there will be generally when you do state that there's an overvalue of any kind, you could write, a bit of commentary to justify and to explain perhaps why this is the case. Next, we have the undervalue. Now, this is again quite crucial. A high or quite large undervalue is not desirable. Now, for any project. Now, the undervalue is essentially whereby you could and should claim for this money, but you cannot. So it's, for example, if you've done a rewire in a property and a rewire costs, I don't know, £3,500 for a large property, and unfortunately your subcontractors have carried out the work, the value is there, but they haven't produced the NICI cert. If they haven't produced the NICI cert, it could be a client requirement that the NICI, or an employer's requirement, that the NICI cert has to be filled out, has to be completed, and has to be issued to the client prior to receiving payment. If you have that instance for 5, 6, 7 properties, that could be a vast amount of money whereby the value is perhaps there, but you're unable to include it in your valuation due to those extenuating circumstances. Now, in this case, I've made a scenario whereby the concrete repairs and external pointing logs could not be signed and claimed for. So this is essentially a similar sort of situation to that of the electrical rewires, except for concrete repairs and external point logs could not be signed and could not be claimed for. So again, that could potentially have been a snagging issue, or it could have been some sort of issue whereby sign off has not been granted, hence monies cannot be claimed. So the end result is that you get an overall value. Now this overall value is the gross value for that period in time. Now, bearing in mind the CVR is conducted on a monthly basis, these figures are generally cumulative. The only the only movement that you should see, which is the 107 grand, is the figure for that period in time. So, just to recap, we have gross application, gross certified, and movement in the month. Next, if we move down to costs, just to give a brief synopsis, before you enter the summary sheet, you would generally run the cost report. On a cost report, that is a system generated report that should, if configured correctly, give a cost and value, or cost and sales report generated from an accounting system or generated from the computer system used within the corporation of the sales and of the costs for that particular month of period of reporting. Now, once you have been given those costs, the next thing to do is split it out between the various categories. So categories generally are subcontract payments or subcontractor direct costs. You may have material costs. You may have preliminary costs and accruals that are associated with subcontractors, materials, and preliminaries. Now, as a rule of thumb, there will always be subcontractor accruals. There should always be material accruals, and there should always be preliminary accruals. And this is because of the way the cost report is run. The cost report is run in a way whereby the costs that have made it onto the cost ledger for the month may not be the current costs that the contract has conceded or has had borne to date. Hence the terminology accrual. An accrual is where costs are borne but are not yet shown on the cost report, and this is the key skill of a quantity surveyor. It's almost an accounting / quantity surveying function generating a cost and value reconciliation, but where the quantity surveying profession comes into its own is in its innate and pretty much superior ability to understand whether or not the accruals are of a magnitude that are representative of the project. Now, it's not just purely reporting on figures, it's about understanding the project, understanding what costs are to come, what costs have been borne, but also what we can forecast going forward so as profit is as accurately monitored as possible. Now, this is crucial to reporting, crucial to the project, but crucial in terms of the profession and in the industry as a whole.